Hello traders, Gary Wagner here just before 10 o'clock in Honolulu, 4 o'clock in New York. On Friday, happy Aloha Friday as we say on the Hawaiian Islands, 4th day of October 2013, and this is the daily report for gold and silver. For the day, we do have gold off about $6 to $7 on the day, 13.10.10. You can see that as the current print. 13.05.50 is the low, 26.30 is the high. The low is significant. We'll talk about that in a second. Daily candles of silver, and this of course is Japanese average format. You can see this day right in here. It's trading actually up about a nickel on the day. 21.41 is a low, 22.02 is the high, and current print 21.74. Quite an interesting week in the markets in terms of events, in terms of reactions to events. We're looking at a 60-minute chart. We have the beginning of the week, and of course the following day, we have the shutdown of the U.S. government. Reaction to that shutdown, market trades substantially lower, actually trading to an intraday low just at around $12.75 per ounce. Now, when we consider that during this week we had a government shutdown, market was trading roughly at the beginning of the week, wherever you want to peg it, but even if we call it 13.35, we certainly by the close are going to close roughly in this area, call it 13.10. We have seen the market drop $25 as the government in the United States shut down. I believe that's interesting to say the least. Now, we are looking at a 180-minute chart, Japanese average format. What I'm looking at right now and what kind of stands out is when we put in our upper level resistance trend line, and we're simply looking at these series of lower highs as this market has traded down through this range, really starting at above 1400 and then dipping, of course, below 1300. We really can see that the market has seen this series of lower highs. At the same time, when we look at our lows, we're also getting a series of lower lows, except for this low right in here. We have been getting a series of lower lows. The only low that really fell out of that pace was right in here. So there's really no other way to characterize the market but in a defined downtrend. And that defined downtrend has certain ranges, and within those ranges we are getting support and resistance areas. Let's take a look at those now. Now, we are looking at a standard candlestick chart, continuous contract COMEX gold. And in this particular chart, I've basically put one fib retracement that starts at the beginning of the rally. This is back, of course, in July. Market's trading at 1181. This was that low after really coming off of a high that began at around 1800, that tremendous fall down. Market has its first real rally up. And during this real rally up, we saw it move from what, 1181 up to around 1433. Once we do that and we put in our Fibonacci retracement areas, 23, 38, 50, of course, and 61, we can absolutely see a couple of very, very critical and important. First of all, in terms of support levels, we currently have tested over the last couple of days 1300, 1306, 1305 to 1308, depending on really where we fix the top and bottom of this fib retracement to get that number. But 1300 is absolutely a critical level of support. We have seen this market throughout the week trade just into the area. I believe our intraday low was around 1292, but effectively close above it in all occasions. You can absolutely see right in here the supportive nature of that price point. However, when this market came down, and these are the series of lower lows that we're looking at right in here along with these lower highs, but we can see that it tested the 61% retracement level, absolute critical support, and this is roughly at $12.75 per ounce. We can see that the market came down, tested this. Now this, of course, was right at the beginning of this month, end of last month, and that is our critical area of support. So basic levels of support we need to look at right now, of course, 1300 and 1276 to see if those levels hold. Now, in terms of resistance, and I'm really not that concerned with resistance right now, the pressure's obviously to the downside. Although, if there continues to be a stalemate in Washington, as we approach the 17th, that's when the government runs out of money. And the belief that there's a possibility that we would default, I cannot see that happening. I don't even think that is remotely possible. Although I wouldn't have bet upon a shutdown last week either. So my take of what the government's going to do is absolutely not in step with what's really happening, but I believe that many analysts have been kind of taken aback by recent actions by the Congress and the Senate as they are at a virtual stalemate. But when we look at this in terms of key levels of resistance, our top level, of course, is 1373. That is your 23% retracement from this large move. We can see market comes down. It really finds support in between the 50 and 61%. We really can't give it either of these two levels as a level in which it found support here. But as it came up, and this is that big spike for the FOMC meeting, they announced that tapering will not begin. And by the way, we didn't get our jobs report today, so we don't really know how the economy has been faring, except to say that besides today, in which the equities markets were up, this entire week they've been down. But you can quite effectively see roughly at 1370 to 1375 a key level of resistance. The next real level of resistance runs at about 1330 to 1335, and that's this band right here. We can see tops here. Here it exceeds, but you can see where it is definitely a resistive area as these markets hit these highs here, but can't take them out. Come down, we test the support level. This is the support level being tested twice. You can then see it again here. Market comes out. We call that a scouting party. That is a pattern that was identified or named by Steve Nissan, in which as this market moves up, the bulls are testing the fortitude of the bears and seeing if they can take that out. Obviously, they can't. The market comes out. But you can see that when it breaks through this level, it breaks through this level with a fair amount of energy being released, which carries it up to that next level of resistance, meaning 1373, kind of trends around there till it gets to this final top, 1433. There is historical data that defines why that area makes sense, but it's not an important area for us now, so we'll leave it out of the mix. So where do we see this market going? Well, quite obviously, when we look at the technical charts, there is no doubt we have seen this downward bias as this market has moved from about 435 down below 1300. We have also seen major support come into the market roughly at 1275. We can see that historically speaking, there is precedence for this, as we have seen the market react in a very logical manner, being supportive of the market here, supportive of the market here in terms of this particular price point. Now, we are looking at a daily chart. We have our current Elliott Wave bear count, which quite honestly is the only count that really makes any kind of sense. And when we look at it, here's what we're looking at. My belief is that this was our intermediate but long move down 3. We then had our corrective wave 4. Corrective wave 4 was composed of an A, B, and C, and we are now probably in wave 5. Wave 5 has probably had a 1, a 2, and 3. We'll probably see a 4 and then a 5. In other words, a 5 count in that fifth wave. However, there's a real wild card, and the real wild card is what is going on with the United States government. I personally cannot see the Fed tapering. One, they don't have the same information that they had last week. We didn't get a jobs report. But even without that report, the economy has been picking up steam, but is nowhere at a state that the Fed considers to be hitting their particular benchmarks, because their benchmark, quite frankly, is inflation and the unemployment rate. So just to put everything into context, I pulled up a 3-day chart. This has got, of course, our major counts, and this is our major third. The key right now is that our major fourth is where we basically went from a bull market count to a bear market count. And my sense is as follows. If we take a look at this most recent activity, and this most recent activity has to do with the rally and the sell-off. This is that rally right here. This is what we're looking at as a corrective wave 4, this being our wave 3, and this being our wave 1 right here. But when we look at it in this way, you can see the A, B, and C. It's in there. It is quite light because I do have the candles compressed together. We can also see what I believe to be, in terms of the most likely count, this beginning of wave 5. Now, in terms of what I find could be a scary thought, and that is that wave 5 traditionally on a flat would have an equal low. On a truncated, which is rare, you would get a wave 5 that would fall above the conclusion of this wave 3, but most likely is a lower low, meaning that you're going to get a lower low than you got at 1181, 1191 if this count holds out. And I find that there's a real inconsistency between what this bear count is saying the market will do and what the fundamental data out there is saying the market could do. Because this scenario, if in fact it comes to a quick and eloquent conclusion, we could really see this market sell off. We factored in up and down what could happen with the government. However, if we get any kind of a stalemate that drags on, we could really see this market take off. Now, that's on a fundamental basis. But when we look at the straight technicals, besides this wave count, the other thing that to me bodes our attention is this is a longer term MACD, moving average convergence divergence, off a 3-day chart. And just take a look at where we're at. It looks as though we have moved back up, but we're going to get across again, meaning it is predicting lower pricing. As I said, we'll have to see how this market wants to unfold. But as of now, we cannot deny the fact that we are still in this current downtrend. This rally gave us some real hope, but at this point, because of where it stalled, I believe that to be probably false hope. And the reason I say that is it was this resistance line. Let me see how well I can draw it in there. And it's based on these series of tops in here. And then, of course, it's extended down. It was the fact that when this market hit this bottom, that was a logical point, 61%, and it flew off of there flying hundreds of dollars, but it stalled just prior to breaking through this resistance line. And to me, that was what was critical. That was the moment that we had to say to ourselves, we're no longer having the option of saying we could have moved back into a bull market count because we failed to take out that upper end resistance area. Now, there's no doubt silver had a really, really tough week when we considered the downside pressure. Most importantly, the intra-week low that it hit, actually finding support at a 2078. Right in here, the 61% again is from the move from 18 up to 25 and then back down. That, of course, corresponds to the 61% retracement in gold that we just identified. And when we look at this marketplace in terms of the straight weekly candlesticks, what you'll see, let's go ahead and blow this up a little bit, is that absolute uncertainty. And each week, the body size has actually gotten smaller. They have been lower closes, meaning small red candles, but more importantly, they're very, very doji-like. So, as I said, on a technical basis, pretty much all signs point to this market continuing in its bearish manner. However, my sense is because of the fundamentals out there, let's keep a keen eye on the market, because I believe at any point this market could really wake up, smell the coffee, and see the kind of pressure that we could see on the US dollar and vis-a-vis what that does to gold. My sense is that we don't know what's going to happen in the Congress and the Senate. And because of that, we really can't make a solid strategy assessment. And that's why we've been sidelined for the week. But as this impasse grows closer and closer to that deadline, the 17th, I believe there will be major pressure, and pressure to move the precious metals to the upside will build and build until and when that issue is resolved. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Have a great weekend. Bye-bye.